Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for Beginners. Weekend Watch List.
G'day and welcome back to Shares for Beginners Weekend Watch List, where we take a close look at an individual company that you may wish to consider for your watch list. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Bapcor Limited, ASX code BAP. G'day, Elio.
Yeah, g'day, Phil. Thanks for having me back on the program. And I suppose this is one of those lessons that we often like to throw in there where we help identify to investors stocks that could be avoided. And there were many warning signals in Bapcor because let's face it, they've been on the skids for the last year and a bit. Its price doesn't look great. And investors may be wondering, is now a good time to buy them, given they do represent some value? And I'm sure we'll cover that today.
So is this the falling knife thesis we're looking into here?
Well, look, as a momentum man myself, so for those that are Stockopedia members, they'll be aware of this, that I do use squiggly lines within my broader strategy. I generally don't like to catch a falling knife. And in the case of Bapcor, I think that rings true somewhat. I mean, we know the lows of GFC, and of course, we couldn't go anywhere, particularly in this state of Victoria, and that hurt the price significantly. But then it shot right back up in 2021, got to around $8 and then guess what? Bang, came crashing all the way back down recently. So if you're a momentum investor, irrespective of the fact that Stockopedia has them rated as 23 at the moment, or the fact that they were even 54 at the time, even before this latest price decline occurred, you were probably not in a Bapcor. And yeah, I think that don't try to catch a falling knife moniker for a DIY investor definitely rings true, Phil, and something that all investors should be aware of.
Well, let's briefly cover this company. Bapcor is a car parts manufacturer, basically. What is it about Australia and car parts manufacturers? We've got so many of them.
Yeah, we do. I know last week you talked about GED and this week it's about Bapcor, but many people will know Bapcor because, of course, part of their business is the retail arm, and a large part of that is Autobarn. And that's a brand that many of us grew up with over the many years. And look, we're a very big country, Phil. So to be quite frank and honest, our transport system isn't that great. So we do rely on cars somewhat. And as a result of that, there's been a massive industry built on the back of that. Mind you, none of it's actually manufactured here, of course. But nonetheless, though, we still drive them and they're still got to be serviced and looked after. And in the case of Bapcor, they do look after not only the retail part of the business, but they've also got extensive operations both in wholesale as well as, of course, at the trade market where they're servicing panel beaters and the various others like that as well. So though it has many strings to its bow, it just has a nasty habit of disappointing and missing estimates. And I think should come as no shock to anyone if you've seen that price reaction recently.
Well, let's talk about that share price action. What happened towards the end of April?
Yeah, so effectively what happened, if I can paraphrase, is the company came out and effectively downgraded its earnings for the coming full year for another time. So you will often see this with companies, Phil, where you'll get the first downgrade, which is generally factors beyond their control, nothing they can do, but they'll be right the next period. Then, of course, comes the second downgrade, whereby, okay, what we tried didn't work, things are still bad, and look, we're going to change something up in order to make something work in our favour. And then the dreaded third downgrade comes, and that is basically we've got no idea what we're doing. We throw our hands in the air, and basically it's up to the gods as to whether we continue as a going concern. And look, I know that's a bit facetious, and I know the old wives' tale of spiders coming three may very well ring true in the eyes of some, but I often find it interesting, particularly as a momentum investor, to see what's occurring just before any possible downgrade. And for keen watchers of the business, 2 days before, the CEO incumbent actually decided to walk away from a $1.5 million per year job plus bonuses, said, no, thanks, but no thanks. I'm not interested in that. Now, Phil, I don't know about you, but if you're offered $1.5 million to effectively take the helm of a business, you'll probably accept, unless, of course, there's something really bad that's going to occur. because, of course, let's face it, your bonuses are all going to be set on what the price is at the day you join the business. So lo and behold, we didn't have to wait long to know if we were wrong, but in this case, we were right, because what happened then was 2 days later, we came out with that big downgrade and the price fell, I think, to its low point, was around 35% on the day. On what was not a disastrous result. I think it's important I remind everyone about that this is not a basket case. It's not a hit and hope scenario. But nonetheless, though, it doesn't look good when the person you employ walks away. Inevitably, something bad's going to happen. And in the case of Bapcor, it did. And as you alluded to, we've seen that big gap down now in price, and we're back to levels that I think it's like 2016 since levels like this were last seen. So it hasn't been a good ride, unfortunately, for shareholders who might bank on the fact that they've had a higher dividend than I suppose what they would have had if they weren't holding that stock. But I think the capital, killing that's occurred is basically one that you need to stay away from in our view. And you know what? The numbers actually don't disagree with my perspective on that side.
So are we talking about the current CEO that walked away from the job, or this job was offered to a new CEO?
No, the job was offered to a chap by the name of Paul Dumbrell, who was going to effectively become CEO of the business, although decided just before the actual activation date that he would not continue with the company and, in fact, would stay in his current role. So the current interim CEO, who is a chap by the name of Mark Bernard, board member, long-standing Bapcor man, as it were, he has still retains the role as the global search continues for a CEO. I think they'll probably find one, given the fact that business isn't a basket case, and now that the bad news is out there, your bonuses get a lot easier to hit. Nonetheless, though, it's not a good look. And it just reminds us all that we can analyse the bejesus out of a stock, as it were, but sometimes sticking your head out the window and actually looking at the weather can be a good strategy as well. So keeping your street smarts about you is also a profitable strategy when it comes to DIY investing.
So to mix those metaphors, you put your head out the window to check the weather to make sure that you're not taking a poisoned chalice.
Yeah, and of course, Phil, being from Melbourne, it's something we regularly do, although it's been glorious down here, even though it's been a bit nippy in the mornings, the days have been wonderful.
Well, non-stop rain here in Sydney for weeks. So Stockopedia has this company marked as contrarian. What does that mean?
We have a system whereby, depending on where I suppose the strengths and weaknesses are for a particular company, will determine what it is rated. And in this instance, as you've alluded to, Bapcorp is rated contrarian, which by its definition means that it's pretty good value, quality's a little bit questionable, but terrible momentum. So just as the name would suggest, you are standing against the tide in regards to this business. And in regards to its value rating, that's currently 82 at the moment. It is its shining light. And unfortunately, that's a little bit of a byproduct of the fact that as share prices go down, the value of a stock goes up. We've rated it contrarian because, quite frankly, I mean, if it's trading on a PE ratio at the moment of 14, an EV to EBITDA of around 8, I mean, it's got a return on capital, which is around 10% or just a little under. So by no means is this a basket case. It has manageable default risk. The Piotrowski score could be a little higher, but that's okay. We're not bad there. And all their profits, or what they are generating, is actually making its way to the bank account. So the cash manipulation is quite low. So again, yes, this is meeting those value metrics that we look at. You combine it with quality, and quality's also been on the borderline somewhat, currently rated 79. So there's still another 800 odd companies above it in theory. But I mean, at least it's not that basket case that's, of course, we fear. But investors, even prior to that, were definitely aware of this. I mean, if I go to, say, back when that downgrade occurred in April, let's say I go back to March at the time of their interim results, so after the latest financials were identified, quality was obviously the shining light there, whereas value wasn't as good. So what we've seen is a big, massive shift there in that regard, particularly with this latest sell down. Momentum hasn't been great because, quite frankly, it's been in a downtrend for a number of years now. I think if I look at the moving averages, for example, the 50-day moving average hasn't crossed above the 200-day moving average for quite some time. It got close, but it failed to do so. And for those that watch the squiggly lines, they'll know what that means potentially. So there's a lot of red flags here in regards to Bapcor, Phil. And I think it's a reminder to investors, if they're going to be DIY, if they are going to be contrarian and they're going to stand against the tide, that they've got to do their research. They've really got to understand the business, pardon the pun, but they also have to understand the drivers in regards to where a company's going. And then you basically make a total decision based on all the sums of probability. And if someone can't show me possibly 800 businesses that were better to consider investing in, then I'll go, hey, quite frankly. And it's unsurprising to see that their stock rank has taken a hit in recent times on that further decline in momentum. I think it's dropped quite significantly in the last 30 days on the back of that big gap down score. So, this is where we're an effective tool, in my view, Phil, and I sincerely hope most people have been able to avoid Bapcor. If not, Stockopedia may very well be able to help.
And this is despite the fact that it's gone up 14 points in the value score recently. I'm assuming that's just a function of the share price dropping, right, isn't it? Yeah.
Yeah, very unfortunate, but it's true. But that's where some Ben Graham followers may be sitting there thinking to themselves, a forecast PE of 14. Well, it's been a long time since Bapcor's been trading around those levels. Therefore, they may be interested in taking a nibble. And if I was to be honest with you, I think I'm starting to hear across the wires that maybe Bapcor could be a possible takeover target. I mean, private equity likes to throw good money after bad at any business. And to be frank, a company that falls 50% from its all-time high, but is still profitable and still able to generate solid profits, that has to be something worth a look. And I think Bapcor is probably one of those. So to be frank, yeah, I think that contrarian rating rates well. But again, when it comes to making a decision, there's a whole balance of probabilities that need to be assessed. And it's much better looking at them now than it was, say, a month ago. But I think I'm stating the obvious in that regard.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So I'm starting to get all these mixed messages from you, Elio. On one hand, it seems like good value, and on the other hand, it's something to avoid. Tell us why we should be avoiding it.
Okay, well, in my view, because I do use momentum, it fails to meet my first rule, which is ultimately that the 50-day moving average has to be above that 200-day moving average. Quite simply as that. Unless, of course, the stock is rock solid on quality, because I also put quality as a major marker for me. When I see a quality score at the time as I did of around 79, I'm probably not going to be all that interested in a business. So it looks terrible on the chart. Its quality isn't necessarily the highest ranking. I don't have the time, patience, or inclination to do much more thinking than that, to be honest with you, Phil. I'll stand on the shoulders of investing giants and I'll go with what they say represents quality or momentum for that matter. And therefore, I gave this a wide berth. And it was not one that came onto my screening process, which I do when I'm assessing a stock. But then if you're relying on the Australian consumer in this current environment where inflation is quite high, interest rates have been going through the roof. I mean, let's not forget, as part of that New Zealand business, it's been tough over there as well. They've seen interest rates go up consecutively as they try to curb inflation and keep that under control. So it's definitely not easier on the other side of the ditch either. So when you have that reliance on that retail part, notwithstanding the defensive non-discretionary part, you're going to face some problems, because why pay today what you could pay tomorrow if you're getting a better salary then? But that's a whole discussion for another day, Phil, and I'm certain your listeners aren't necessarily going to be interested in that right now.
Well, what I'm interested in discussing is that their business is divided into non-discretionary and discretionary. So what are the percentages and how much of this is inelastic demand? And I'm assuming this is feeding into some of the outlook for Bapcor.
Yeah, very much so. It's the 80-20 rule. The company tells us that about 80% of their total earnings are non-discretionary. and 20% are discretionary. But you ask a really important question in regards to how much of that is inelastic. How much can you effectively not live without? I mean, let's face it, changing brake pads, possibly that is an essential item versus a new floor covering. Well, you know what? Maybe that is discretionary. So they do simplistically break down non-discretionary and discretionary. And non-discretionary is obviously made up in large part by their trade business, what they sell to wholesalers, car on sellers, those types of things, versus the 20%, which is the Autobarn business. But actually, in terms of revenue, is actually much higher than that. So when you've got a rising cost of doing business, plus the demand side of your business is starting to disappear, there's going to be pressure on your margins, which is what someone like a Bapcorp has found. And as margins are the great profit expander, you're probably going to see that also impact their business in the near term, as you can see by the price in recent times. They don't necessarily break up too much how much of that non-discretionary element is actually inelastic or not. I think it's, again, I would break it down to 80-20. So I would say that 80% of the non-discretionary spend, which is also 80% of their total business, I would say that basically that would be elements that they can't ignore. I mean, no one's going to be throwing away their car anytime soon, I dare suggest. So you still need to incur those costs. Whereas about 20% of the non-discretionary element probably is something that mum and dad is sitting at home thinking to themselves, okay, I don't necessarily need to fix this right now, therefore I won't necessarily go and do what I have to. So these are the sorts of things which do move a business like Bapcorp. I mean, I noted that poor performance in New Zealand, which was obviously a major issue for the business in recent times. So hopefully now they've got this downgrade cycle behind them. I think, as you can see, the value score for value investors, I'm not one, but there may be some out there that would consider something like this now that the fact it's been so long since it has been this cheap. There could be a takeover premium. I'm not going to guess that. I haven't done the work and the spreadsheet work to identify whether that's possible or not. All I can say is that there's a lot of learned people out there looking at this $1.5 billion business, and the share price hasn't been great. So what else does it need to tell me as a DIY investor? As a momentum guy, I usually put quite a bit of emphasis on that. And in this view, it's a clear avoid for me, irrespective of the fact that a core part of their underlying revenues are from that non-discretionary element.
Just anecdotally, I mean, I love going to Autobarn, and looking at what's available, and sometimes you do make that purchase. But it's this situation is when buying a new sunscreen for the windscreen. In the past it would be like $20 for a really nice RM Williams branded sunscreen. That's okay, but now it's like, no, I'm not going to buy that because I know I can buy a cheap one from Target for $5.
Exactly. No, competition, it doesn't have that big economic moat. I mean, let's face it, all you need is a bit of shelf space and you can effectively sell whatever you want. And given this idea, unlike GUD where there's a solid manufacturing component, in many cases, Bapcorp is a reseller. And that's just not a great business to be in at the moment on the back of all those concerns that we've heard ad nauseum. Yeah, like walking in, but then actually opening up your wallet and buying something, that is a different question. And I think we've seen that across the board. Though I do note, and big congratulations to ARB Corporation, who came out the other day. I think they actually upped their guidance. But then again, they were coming off a disastrous period. So that wasn't a disaster, or that wasn't unexpected, as it were. So hopefully the same can happen for Bapcorp, but I'll let other people test that theory with their money.
So you've discussed the momentum. What about the financials? Is there anything in there to look at?
Look, at the moment, there's not. I mean, other than the fact that the company did come out with that profit downgrade that everyone needs to be very much aware of, there's possibly not that much to further at this stage. It makes it a little hard because when you're looking at a business that comes with an earnings downgrade, by the time that you then include all the expenses plus all the impacts on the balance sheet, etc., to do that full assessment, you can only really do that once you get the full disclosed numbers. And as I alluded to, in the case of Bapcorp, they last released in February. So we've got to wait basically till August till we see the fruits of this labour. So yes, we know that sales are down, but I could tell you what, bet your bottom dollar, and I'm not the only guy that's betting this, that the cost of doing what they do has gone up as well. So hence that margin pressure that I spoke about. At this point, no, there's possibly not too much to look at, because not that we can throw out the baby with the bathwater, because their previous downgrades are sort of all wrapped up and captured in this latest half-year result that they did release, which, again, wasn't necessarily suggesting that the company was a basket case, particularly on the fact that they were profitable, despite the fact that earnings growth did decline. They were actually making a quid, and money was actually going to the bank. And though revenues were relatively flatline on where they were previously, they weren't going to be going anywhere overnight, as it were. So again, that adds further weight to that value metrics being so strong for those that are brave enough to stand against the tide, that maybe Bapcor could be representative for them if they're a contrarian investor and they want to identify contrarian stocks, but just not for me personally. I prefer to run with the bulls, as it were, rather than necessarily try to stand against them. But obviously, if I look at analyst forecasts, that's probably a big bellwether for me, Phil, when I go and see what's that going to look like. Well, it ain't great. I mean, earnings per share for 2024 and 2025 are at their lowest point in, 12 months, and I dare suggest even further beyond that. And even this latest update from the market saw a further downgrade on the stock, particularly in 2024. So even though I see that the general consensus is sort of around that hold area with a slight bias towards the buy, I mean, given that they are eternal optimists generally, very rarely do you find a sell recommendation on a consensus basis. That does, leave me a little worried that the broader market consensus view is that while it's not a basket case, it's going to take some time to turn around. Like a big VW, as it were, to try to turn that on a pivot is a little bit hard. It's going to have to do a few reverses, I think, before it gets back onto the straight and narrow. And then once it does that, I'm sure that'll be reflected in the price and the other metrics that Stockopedia looks at. But for now, it's in the too hard basket.
So I guess we're calling it the Elio D'Amato thumbs down until that 50-day moving average crosses the 200-day moving average. Did I get that in the right order?
Yeah, well, not to take a quote from anyone else in regards to I don't get out of bed for at least $10,000 a day. I think what I will say, though, is that, yes, there's no way that this is going to appear on my radar, as it were, until two things happen. One, that 50-day average crosses above the 200, as you alluded to. And two, the price actually gets above the 200-day moving average. I mean, let's face it, the price is well below that at the moment, Phil. So there's plenty of time for the bus to pull out of the station on this one here. I don't see any need to necessarily try to catch that falling knife, as you alluded to, but I can't dismiss the fact that this is value at the moment. And I think for me to deny that would be sticking my head in the sand, because underlying this is a solid business. And for those that are brave enough to stand against the tide, it may very well prove to be an opportunity for them. And we've seen these sort of examples in the past. I mean, you throw up stocks like ResMed, for example. Woolworths is going through a scenario like that at the moment. Big companies, rock solid, blue chips with strong underlying demand that for whatever reason the market just takes a pessimistic view on. You get that share price decline. When you have those deep pullbacks, then, contrarian and value investors should be looking at those sorts of businesses, hopefully before they run, of course. But Bapcor may prove to be one of those. If it continues to tick the boxes that it has been, then it most likely will be. But personally, I'd prefer to see a bit of favour return to the price, and those two indicators are things that I will be looking at.
Elio D'Amato, waiting for that golden cross. Thanks very much for joining me today.
Thank you very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.